Hello everyone, my name is Natalie Gaspar and I'm the General Manager of Easy Stay Hotel. And today I'm going to present to you my management team, Team 8.2. So first off, we have Alice Fioroni, who is our Head of Marketing. Then we have Anna Pravo, our Front Office Manager. Then Chanel Yousefi, Head of Human Resources. Delia Leitenberg, our Revenue Management Manager. And Mo Chai, our Assistant GM. So girls, I brought you here today just to thank you again for the performance this year. I wanted to recap about our year's evaluation so we can improve for next year's revenue management program. So let's have a start by giving you background information about Easy Stay Hotel. So for our property description, we are a 3 to 4 star hotel located in the city center, including 250 guest rooms, 50 premium and 200 standards, 1 restaurant, a conference space, a pool and an exercise room. For our market image and vision, we are an unpretentious, luxurious hotel trying to combine technology and comfort. Our vision is to create a more business-focused and centrally located hotel. Now for our quality, our hotel has not been refurbished since opening, but the quality offered by the competition set is quite similar. The property, along with other hotels in the competitive set, have experienced steady performance decline over the last 2 years. Okay, so now I'm going to give you an overview of our strategy. So for our positioning, we are focused on maximizing our occupancy, offering lower room rates than our competition, and in doing so, we're going to offer lower rates during the weekdays for business guests and higher rates during the weekends for our transient guests. We are also going to adapt a rate parity strategy for transparency. Now for our pricing, we are focused on a competition-based pricing. Now the pros of this strategy would be, for instance, that we have monthly reports of the competition prices, which gives us the ability to adapt their price to their prices and stay slightly lower than them at all times. Now for the cons, in our report we noticed that our prices were lower than what we could have actually charged for the rooms, and we therefore did lose some revenue opportunities. We have decided therefore to increase our prices slightly over the long run to improve our stability and our ability to generate larger revenue. And finally, for our service level, we are a more budget quality hotel.
Now let's have a look together at our annual plan where we set objectives at the beginning of the year. Our 2 main objectives were to achieve and maintain an above fair market share and an ADR equal or higher to our competitive set, as well as generating an annual GOP in excess of 25%. If we look at this comparison table, we can see that the objectives that we set and our actual performance, we actually achieved a good room market share compared to our comp set, even though our ADR was below competition. Finally, concerning GOP, we managed to almost double it, which is really good. Now moving on to revenue. On the slide, we highlighted some important numbers concerning our performance this year. What really caught our attention is profits, which was really low compared to revenue, and this might be due to high costs concerning marketing expenditure, refurbishment and renovation, which we will further analyze later on in the presentation. We experienced a peak in profit during the months around August here, but unfortunately in July we didn't reach the profits we were expecting, despite it being high demand season, due to the mistake we made in accepting the reservation of the group. In terms of GOP, the general trend was quite positive, increasing slowly but steadily until August and finally decreasing at the end of the summer. Concerning occupancy, we can see that it was quite stable throughout the year, except from a positive and negative peaks here, which corresponds to the months where we had the 2 group requests, and of course an overall increase during the high season. Further, we can clearly see that there is no strong difference between weekdays and weekends, but we will develop more on this later on in the presentation. Now, moving on to market indexes. In terms of market indexes, we just saw that occupancy index was above comp set throughout the year, except from 3 months. ADR index was pretty much always below competition, while we managed to keep a RevPAR which was a little bit better, with 2 clear peaks in April and August.
So for the Q1, during the first month, we had a high variance and we decreased the pickup in order to be more realistic. We set January rates according to the maximizing occupancy strategy prices available on the booklet Throughout the quarter, we tried to follow the strategy by trying to guarantee the lowest rates among the competition. We did the cleaning of premium and standard rooms to be prepared for the upcoming year. We built a meeting room in order to improve the service offered to business guests. We spent a lot on the cleaning because guests are willing to pay more for clean facilities according to the forecast. We invested as well in an executive lounge to satisfy business guest needs. For the marketing, we set a constant marketing of around 6% of the revenue. We firstly focused on direct and OTS channels, mainly targeting groups and transient guests.
For the quarter 2, in April, we adapted our pickup according to the group request we received. The 2 following months, we increased the pickup according to the demand increase, as high season is approaching. In April, following the group request, we increased our rates around 10 to 25, as a lot of our rooms were already guaranteed. The following month, we continued to follow our pricing strategy by setting slightly lower prices than the competition. Except in June, where our rates were way lower than competition. We did a mistake in the variance, and we decreased it instead of increasing it. For the refurbishment, we cleaned it and did a soft good review of the associate facilities, because our quality was below 50% in the reputation management report. On top of that, we renovated the front desk and the environmental program. In June, we cleaned most of our facilities to be ready for the high demand summer season. We set up a valet parking and tour and travel desk to improve our available facilities, and we increased our marketing expenditures as the demand was increasing compared to quarter 1.
For the third quarter, we adapted the pickup following the group request we received in July. The following month, hotel reported a significant increase in demand due to a peak season up to 65% or more. In July, as a consequence of our mistake in the variance, we increased the occupancy forecast, but it was way too high. We should have gone more smoothly and increased it step by step. In the next month, we tried to adapt better our rates. We decided to increase our service quality by ensuring clean facilities and investing in decoration to make the spaces more comfortable. On top of that, we renovated the reception. We invested in lobby kiosk, hoping it will eventually bring additional non-room revenue. We started to take competition indexes into account and always tried to be ranked first. For the last quarter, the demand slightly decreased and we adapted our pickup consequently. We readapted our rates by decreasing them by $10 to $20 to match the change in demand, decreased in October. We decided to invest for the last time of the year in soft good review to guarantee an acceptable comfort and quality until the end of the year. No investment in facilities and services, as it was the last quarter and the one with less demand. We continued with the same marketing strategy to maintain our leading position.
So now let's have a look at the request for proposal. So we made a bid on 4 group bookings, April, June, July, and November. We received 2 of them. In April, we had 2,080 rooms for the weekdays, and in July, we had 2,400 rooms for the weekend. For April, we proposed a rate of $85 after calculating by adding all the costs of March and 25% profit. Our performance was really good. Our MPI for groups was almost double than the competition, and our occupancy was also higher. It was very beneficial for our hotel as it brought a lot of revenue and a high occupancy. For July, we proposed a rate of $100 after again calculating by adding all the costs of the previous month and this time 45% profit due to high demand season. Our performance was worse than expected. It was high season, so we expected a high occupancy, especially with this large group booking. But in the end, our occupancy was 11% lower than competition, which is completely the opposite of our initial strategy. At least our MPI for group was higher than competition, but it does not mean a lot if RevPAR or occupancy do not follow. In this situation, accepting the group booking in July was not a clever idea at all, and made us worse off. We lost important revenue as the group rate was very below the average rate during high demand season. Instead of having the group paying so low, we could have sold those rooms to other guests who were willing to pay more due to high season. Before bidding this rate, we should have analyzed better the market demand and the competition. Okay, so here is again our yearly occupancy graph, which clearly demonstrates two major peaks during the two large group bookings. The first one, here, represents the April group booking. We clearly can see that it was the highest weekday occupancy throughout the whole year, which was really aligned with our strategy. The second one, here, illustrates the July group booking. In terms of occupancy for weekday, there was a drop. We can see that here. But for weekend, it was with June and August the highest percentage of the whole year. We can see an increase just there. The group booking on weekend helped our hotel to be so high in July, but really made us worse off during weekdays for the reasons stated in the previous slide. Okay, so now moving on channel distribution. This table shows the comparison between the percentage of room distributed to the 4 different channels: direct, GDS, OTAs, and wholesale, versus the real booking percentage on channels illustrated by the graph above. First of all, we kept the same distribution proportion during the whole year. We did so because some distribution channels, such as OTAs, would penalize us if we reduce the number of rooms we provide them during the different market demand season. Our distribution was quite aligned with our actual revenue mix. We can see a slight difference of 9% in OTAs. We expected OTAs to be a less profitable market channel in terms of room distribution. The opposite happened with GDS and wholesale, at almost 5%, here and here. Hence, we would have reduced a bit the number of the rooms on GDS and wholesale and distributed them to the OTAs. Overall, we are really satisfied with the results, as they are very similar. In the future, we will try to continue with this proportion.
Our focus is low rate, so we offer budget and reasonable quality that aligns with our strategy in order to get high occupancy. However, we ended up facilitating the hotel in excellent quality, more than you would get with the low rate that we offer. So that means that we should have increased our rates, as we were the hotel with the cheapest but almost the best in quality. Because of this strategy, we lost a lot of potential revenue. So here's a comparison between the month of February and October in the price value map. Then for the marketing segment, we decided to invest more on the weekdays than that of for the weekends. However, eventually there is no real impact on the occupancy percentage of the hotel, as we can see it in the table of the beginning of the presentation. Our marketing strategy also impacts our ADR. Even though we mainly focus our marketing expenditure on weekdays, the ADR for both the weekends and the weekdays turns out to be only slightly different. As we can see it in this graph, there's a general increase in RevPAR since the beginning of the year. Concerning with the weekday and the weekend, weekdays RevPAR is slightly higher than the weekend's RevPAR, as occupancy was quite similar as seen before. However, the rates were around $10 to $20 higher than that of the weekend. We can see that the RevPAR curve is quite constant, except in July, where we had the large group for only $100 per room, which made our weekend RevPAR drop drastically.
On this slide, we will analyze our segment mix through the year. We noticed that the bar rate is the segment which brings us the most revenue. We can see overall that the market segment was constant during the whole year, except during April and July, where we had the 2 large group bookings, which obviously changed the proportion of the market segment mix. We think that this result may be due to the fact that we invest more in transient marketing. However, on this slide, we can see that it is not the case. More than 50% of the total of our marketing expenditure went to the transient segment, but they were only represent 1/3 of our occupancy. That is why we think that our investment certainly increased the occupancy, but in another hand, we spend too much in transient guests. In the short run, we recommend to be more flexible with the strategy. At the beginning, we were too much focused on our price and not enough on the environment. We also decided not to change the distribution channel mix to stay coherent, but some adaptation should be done in the future. Also, in the future, we would carefully analyze the market before doing an offer for a group. In the long run, we should keep on investing in refurbishment and facilities to keep a high standard of quality for our customers. We should be more flexible with our pricing and positioning strategy. And finally, we should also focus more on the revenue than occupancy. Thank you really much for your attention on the behalf of Easy Stay Hotel.